The market went almost nowhere today with the S&P down 0.17%, closing at 5396.63. It was an inside day on the charts and the narrowest trading range that we've seen basically since the last week of March. All of these candles since then have been really wide ranges as the volatility index has been super high considering all the tariff headlines. The broader market continues to remain in negative gamma exposure territory with the skew in the options chain tilted to the downside. The largest gamma exposure concentration is sitting right around the 5400 strike on the S&P. We've also seen the 5200 strike being a large factor in negative net GEX. In terms of the technicals, the chart still has not broken this downtrend line that we've been in since the middle of February at the highs. However, we are above the whole moving average. This is the 20-period whole moving average, as well as the 50 EMA. The 50 EMA is sitting at 56.44. And the 20-day whole is sitting at 51.85. Coincidentally, or maybe not, the zero gamma exposure level is sitting just below 5,600. So there is a lot of factors right around this downtrend line, both technical, gamma exposure, and the overall trend all coming to a head at this point. So it's our expectation that the market will continue higher into this trend line where all of these factors are coming into play just below 5,600. And that's going to be a big decision point for the market overall. Above that level, and we get back into positive gamma exposure territory, we also get above several major technical indicators and we break that downtrend line. However, a rejection could be bad news for bulls as the market would have a higher probability of retesting those recent lows that we saw last Wednesday.
Thanks, Anthony. So let's take a quick look at VIX and VVIX. One thing that we mentioned in the past is that we look for divergences with VIX and VVIX. It's not time frame specific, but it does tend to be fairly accurate, within a certain range of time in seeing a spike. The VIX did close near the highs of the day, despite VVIX being red. So that is a divergence that we want to keep an eye on. Looking at the VIX, we still have this GEX at the 42.5 strike. It's just below the whole moving average. We did see volume at lower strikes, including as low as 16, but we also saw volume as high as 50. So an active picture, but not one that provides a lot of clarity in terms of whether the VIX drops before it rises again, or if we're going to rise potentially into the end of the week and then see more upside starting next week for the market. So this is something we need to be cautious about as we go through tomorrow's VIX expiration, and a lot of those hedges are removed, and the field's then wide open for new positions to be established.
Thanks, Sean. Yeah, I know we've been able to capture a lot of profits looking at that VIX-VVIX divergence over the past year, so it's a really great signal, forewarning of potential issues to come. Next, I want to take a look at IWM. IWM also flat on the day, closing at 186.76. It's really been a big laggard compared to the rest of the market, not really having much of a bounce relative to the sell-off that we've seen over the last couple of months. IWM, you can see peaking here back in the beginning of December, whereas the rest of the market really peaking in mid-February. Sean, you've been pointing out the gamma exposure at the 190 strike really over the last 6-7 weeks. We came down right into that 190 strike, ultimately going even beyond that, which you also highlighted as a possibility. Now we're bouncing back up into that 190 level. However, the weakness in IWM gamma exposure is still there. We're not seeing hardly any positive gamma exposure here to the upside. And I'm looking for a potential rejection around this 190 to 195 zone, or at least a consolidation around this level for another week or two. We did see big volume between 180 and 190 today, and that's one of the indicators that we like to look at. If we see volume coming in at higher strikes, we know that market participants have an interest at a move higher in the underlying. But we're not really seeing that with IWM yet, so it's something we're going to continue watching to see if there is a possibility for further upside. Thus far, though, IWM still looking very weak.
Let's take a look at Uber, which I don't think we've looked at before, or at least it's been a very long time. It has rebounded just like a lot of other stocks with the markets recovery off of these early April lows. GEX is positive, but also we have a positive picture in terms of the size of these positive strikes relative to other strikes and the volume that accompanies that. A lot of the GEX for this Thursday's OPEX is between the 73 and 78 strike. Obviously, the 78 strike would be a nice move, but we may not necessarily see Uber reach this higher 80 level, which is also our upper dealer cluster zone. But any dip toward this 70 area, given the lack of meaningful GEX beneath the current zone where we're at, but the way it looks now, pretty good odds of reaching this 80 zone. And it seems that the volume indicates that participants are also interested in that possibility.
Thanks, Sean. Next, I want to take a look at Palantir. Palantir had a big update today, up 6.24%, closing at 98.40. The high of the day was 98.95, getting very close to the large gamma exposure concentrated at the 100 strike. And this is a name that we actually played in our portfolio. We highlighted this to our members back on March 27th. We put on an iron butterfly expiring April 17th, so that's just a couple of days from now, targeting that 100 strike. At the time, had just pulled back from the 100 strike, closing around the 93 level. We did see some further downside before the recent rally that we've seen back up to the 100 level, but this just goes to show you the importance of these gamma exposure levels. This was a perfect example. OPEX coming up here in a couple of days, and Palantir gravitating right back up into that large gamma exposure concentration at the 100 strike. This was a more speculative play in our portfolio. We did get in early, as I mentioned. We got in back on March 27th, so we were early. We had to withstand this dip here, but again, this was an iron butterfly that we put on, and so the risk level that we were taking was relatively low compared to the reward potential. And this is how we play a lot of these names when we're aiming for these large gamma exposure concentrations. We use an asymmetric risk reward strategy where we're taking relatively low risk for outsized reward potential, aiming for these large gamma exposure concentrations. If you're interested in learning more about our methodology or seeing how we manage our own geek portfolio, I'll put a link down in the description below for you to check out.
Thanks, Anthony. Let's look at TXN, that's Texas Instruments. And a lot of these semiconductor stocks just don't look good. And it may be a concerning sign for the broader indices, but I do think there might be an opportunity here with TXN. You can see we have a lot of volume and a large GEX cluster here at 150. The current price being 151, and the sharply declining whole moving average is at 147.53. I don't know that we'll make it back to the high that we reached on April 8th. That was that last Wednesday where the market was up 10%, but it looks like we have a pretty good chance at reaching 160. And to give a different view, when you look at the way that the GEX picture is laid out using our GEX data graph, there's really not a lot of interest in prices below 150 with TXN, despite having negative GEX. It's in a downtrend, but it's a rebound play, and we do have this big GEX cluster at 160. So as long as 150 holds, I'm going to look for 160 and probably say goodbye to this stock until the picture resets again.
Thanks, Sean. Let's take a look at Google. Google down today 1.74%, closing at 156.31. This is another one of those names that we've been playing a premium collection strategy on, focusing on the large gamma exposure that's been hovering between the 150 and 160 zone. Google's been basically in a really nasty downtrend ever since early February, where the stock peaked above the highs at 200 and has since sold off over 33%. However, the last several weeks we've seen some consolidation around this 150 level, and according to the GEX data, that is likely to continue over the next several trading sessions. We're seeing most of the volume in the options market between 155 and 160, and so this is a name that we think is going to stay in this 150 to 160 range at least until we see some resetting in the options chain after this OPEX cycle. So we'll take another look next week to see if there is any shift in the gamma exposure data after all the monthly contracts roll off this week. But so far, it looks like Google is going to take some more time before it can recover off of these lows here. And if you guys want to see all the moves we're making in our own portfolio, as well as get access to our gamma exposure dashboard and our algorithmic trading strategies, head on over to geeksoffinance.com. Currently, we are running a special promotion, $300 off our yearly portfolio manager tier subscription. Use code Easter 2025 at checkout. We've got a few spots available, so take advantage of that while you can. Members also get access to all the premium channels in our community Discord, so you definitely don't want to miss that. Link in the description below. Thanks so much, everybody, for watching, and we'll see you guys in the next video.